Introduction to Accounting. Fundamentals of Accountancy, Business, and Management 1. ABM_FABM 113A1-8. Module 1. By Engineer Julie Ann D. Cuizon, LPT, MA Ed. Do you know that accounting is one of the oldest professions in the world? It has evolved throughout time, addressing the needs of society. In all walks of life, its relevance can be seen. It has system and process that help business owners to understand the flow of their transaction. It truly plays a necessary role in the business. Accounting is part of our daily life. It is essential in the world of business because it functions as its language and provides information that is useful in decision-making. It has its own characteristics, nature, and origin. Simply, understanding accounting will help an aspiring accountant or business manager understand how the business works. Let us first define accounting, its nature, history, and users of the accounting information. Being an ABM student, you wanted to deepen your knowledge and skill in accounting. What is accounting? It is a process of identifying, recording, and communicating economic events such of an organization to related users. Wiegand, 2005. Economic events include purchase of materials, sale of goods, and acquisition of machinery, which are measured in monetary terms and are recorded in the financial statements. Let us define and discuss the three processes of accounting. Identifying. It involves in the selection of the economic events which are important to a particular business transaction. Examples of transactions in a merchandising store are sales of merchandise, purchases of merchandise, and purchases of delivery truck. Recording. It is the act of keeping a chronological record of events that are measurable in accounting documents like journals and ledgers. Communicating. It refers to the process of communicating financial reports to the users of financial information. Nature of accounting. We know accounting is the systematic recording of financial transactions and presentation of the related information of the appropriate persons. The basic features of accounting are as follows. 1. Accounting is a service activity. It helps decision makers by giving them financial reports that will guide them in making sound decisions. 2. Accounting is a process. It refers to the method of performing any specific job step by step according to the objectives. It performs the specific task of collecting, processing, and communicating financial information. In doing so, it follows some definite steps like collection of data, recording, classification, summarization, finalization, and reporting. 3. Accounting is both an art and a discipline. It is considered an art because one records, classifies, summarizes, and finalizes financial data. The way something is done is referred to as art. It is a behavioral knowledge involving an established creativity and skill to help one achieve distinct objectives. Accounting is a systematic method consisting of definite techniques, and its proper application requires applied skill and expertise. So, by nature, accounting is an art. 4. Accounting deals with financial information and transactions. It records financial transactions and data, categorizes these, and finalizes the results given for a specified period. Accounting only deals with financial and not with non-monetary or non-financial aspects of an information. 5. Accounting is known and characterized as a storehouse of information. It collects, processes, and communicates financial information of any entity. History of accounting. In history, accounting is as old as civilization. Remember, the barter system is an old method of exchange. This system has been used for centuries and long before money was invented. People exchanged services and goods for other services and goods in return. It was developed in response to various social and economic needs of men. It started as a simple recording of monotonous exchanges. Its history shares the similarity with that of finance and business. Evolution of accounting. The cradle of civilization, 3600 BC. In Mesopotamia, record-keeping was done through clay tablet as evidence of recording transactions. From India and China to Central and South America, the clay tablet records the business transactions like accounts receivable and accounts payable. Double-entry bookkeeping, 14th century. The most relevant event in accounting history is generally considered to be the dissemination of double-entry bookkeeping by Luca Pacioli, father of accounting, in 14th century Italy. Pacioli was much revered in his day, and was a friend and fellow of Leonardo da Vinci. The Italians of the 14th to 16th centuries are recognized as the fathers of modern accounting and were the first to use Arabic numerals than Roman, and for following business accounts. Summa Arithmetica was written by Luca Pacioli, the first book issued that contained a detailed chapter on double-entry bookkeeping. French Revolution, 1700s. In this period, the development of accounting theory has begun and was influenced by social upheavals. The Industrial Revolution, 1760 to 1830. The focus on this era are fixed assets and mass production. The beginnings of modern accounting in Europe and America, 19th century. The modern and formal accounting profession emerged in Scotland in 1854. Most accountants stayed in the U.S., establishing accounting practices and becoming the origins of several U.S. accounting firms. The first National U.S. Accounting Society was established in 1887. The American Association of Public Accountants was the initiator of the current American Institute of Certified Public Accountants, ICPA. The present, 20th century. In the present time, accounting standards were established and practitioners follow the rules of international organizations or groups like ICPA. Modern accounting standards were given more attention and time. External and internal users of accounting information. External users. These are the individuals or organizations outside the company who are not involved in operating the business. Here are the examples. Creditors. These are users who need accounting information to determine the credit integrity, worthiness of the organization, and credit terms. Tax authorities, Bureau of Internal Revenue. It is a government agency that verifies the accuracy of financial data to ensure the credibility of the tax returns filed by the business. Investors. These are users who need accounting information to evaluate and examine the feasibility of investing in a company. Customers. These are users who evaluate the financial information of its supplier to keep stable source of supply in the long term. Regulatory authorities. These are government agencies like Securities and Exchange Commission, SEC, Department of Trade and Industry, DTI, Department of Labor and Employment, DOL, were established to supervise if businesses comply with legal requirements in running a business. Let us discuss now the internal users. Internal users. These are individuals inside the organization who plan, organize, and run the business. They are directly involved in managing and operating the business. Internal users are also called as primary users of accounting information, and some of these users are the marketing managers, supervisors, finance directors, company officers, and owners. The following are the internal users of accounting. 1. Management. To know the income/earnings for the period, sales, available cash, and production cost are the reasons why the management needs the accounting information. They also analyze the organization's performance and position, and take appropriate measures to improve the company results, sufficiency of cash to pay dividends to stockholders, as well as the pricing decisions. Examples: the managers of the business, the presidents and CEO of the company, the people behind the decision-making of the business. 2. Employees. For job security, they use financial information as factor to consider in staying employment or to look for other employment opportunities. 3. Owners. They use financial information to know the profit or income for the period, resources, or assets of the business. Liabilities of the business are needed by the owners. They also use financial information in considerations regarding additional investment, expanding the business, and borrowing funds to support any expansion plans.